Now, when we're talking about investing in individual bonds and stocks and such, um, that's if you have the money to do it, it's kind of nice in some ways, but it's also one of the basic problems with that is that understanding, and this is something that's very difficult for people because everyone thinks that they're brilliant and so on and so forth, that they have a better way to do these things. But the problem with that is that you're not alone. There are millions of people that are paid good money to be out there researching all of these investment opportunities, whether we're talking about again bonds or stocks. They're out researching these companies and these different market sectors, and there there are analysts that are paid very good money to do this, to do this on a daily, on a regular, minute by minute basis, all around the world. So what that means is that if you step back and look at it, um, first off, do you have the time to do this? Do you have the time to go out there and do the research that's necessary? No, no one person does. It's not to say you shouldn't be interested or shouldn't be involved in what's happening in terms of companies around the world or in your neighborhood or et cetera. But it's just that there's just too much information. There was too much information 100 years ago, and there's uh, many times over that information today. So the point is that how do you beat the game? You have to realize that you can't beat the house, right? So in the casino. So the idea is that, well, do you gamble? No, you don't gamble, but nonetheless you still go to the casino, get free drinks and so on and so forth. But also the way to minimize, we'll step away from the casino. That was probably a poor analogy, but what you're looking at is the one thing that has been certain. There's been change is always certain, but the one thing that's been certain about that change is that over the course of, we'll say, the last 150 years, the value of companies overall has increased, has grown. And so what you want to do is to put yourself in a position where you can take advantage of that, where you can realize some of that gain going forward. There's no promise, because just by looking at the past, you can't predict the future. That's just the reality. Things happen. The COVID pandemic, for example, has certainly shown us that things, you never know what the future is going to hold for you. At any rate, you know that there are going to be surprises, but just the same, the idea is that in the financial sense, you're saying, well, if I give up the idea of me being a super duper genius, whether I am or not, um, I still can get my head wrapped around all of these investments. I can understand, I can teach myself, I can learn going to classes and become a financial wizard and so on and so forth. But that is not going to move me very far along the track in terms of gaining an edge, if you will. So setting that aside, and on top of that, to remember, by gaining that edge, you've got to put in an unbelievable amount of time in this. If you're willing to, there's a very high opportunity cost associated with this. And so you're far better off, frankly, uh, rather than investing in individual stocks or focusing on individual bonds, if you will, you want to reduce your risk. So what you would do is, through the process of what diversification and also asset allocation, meaning diversification is to spread don't put all your eggs in one basket. Again, these adages that come to mind, that's a diversification. The allocation would be to, if you want to focus on one particular segment, part of the economy, you can do that. But you overspread it over a number of companies, for example, or in my one piece of advice I give is that Vanguard, for example, it's a mutual fund. They have a total market fund. Fidelity has the same, and all of the TD America. I say TD America, they're a trader, but the point is that there are numerous mutual funds out there, families of mutual funds that do the same type of a thing. This is their stock. This is their role in the marketplace, is by gathering these financial securities, these bonds and these stocks, and grouping them together. And what you do is then you're buying shares in this mutual fund. So you're not buying the stock directly, you're buying into this mutual fund, and the mutual fund is actually buying those shares of stock, those individual shares of stock. So reducing your liability, your risk rather, associated with that, the beta in particular. There's non-diversifiable and diversifiable risk. You can take care of the diversifiable risk. The non-diversifiable risk, that has to do with the ups and downs of the market, and no one can, unless you're lucky, and it happens, no one can really deal with any certainty with that. So you're going to have to go with what happens with the market itself. So explain the characteristics of mutual fund investments, classify mutual funds by investment objective, evaluate mutual funds, describe how and why mutual funds are bought and sold. Mutual fund is an investment vehicle offered by investment companies to those who wish to pool money from many investors, buy stocks, bonds, and other financial securities, have buy, sell decisions made by the fund manager themselves. There are different strategies that would be involved with that. Passive, meaning you just go with whatever the index is, whatever the market that you're trying to capture, and just whatever happens kind of happens, and you recalibrate on a daily basis based upon the value of the stocks in that portfolio. At any rate, many mutual funds chosen for inclusion in Roth IRAs, 401ks, etc. And this investment company, this mutual fund, pulls the money of many investors, its shareholders, to invest in a variety of securities. So you're buying stock, if you will, in that company that's buying these stocks out there in general. Employs fund managers who are compensated for selecting securities appropriate for the fund's stated objective. They are a financial intermediary, as are depositories, as are life insurance companies, etc. A mutual fund is one type thereof of a financial intermediary. Professional management, these are the fund managers, and they're giving marching orders as to what it is that their objective is. You're going to be buying shares of stock, for example, you're focusing on the auto industry. So you're working in the best interest of your shareholders, if you will. You try to purchase the right stocks, pick the right stocks for the auto industry. If Toyota is doing very well versus Ford, you would probably buy more Toyota stock than you would Ford stock, for example, but you would think that the Ford stock is going to be bouncing back, so you buy more Ford stock. So this is an active person actively purchasing or making these trades at your behest within that pool of that asset allocation group, if you will. Typically, we don't drill down on specific areas like an auto industry, but you could. Typically, what happens is that you look at the size of the firms in that market. Large cap funds, large funds like the large companies like Apple and so on and so forth would be in one grouping. Mid cap would be a smaller grouping, something probably regional or within the state. Whatever, just a smaller company size-wise, so far as like sales are concerned, etc. And small company would be again not necessarily your corner store, but smaller companies that are smaller in size in terms of sales, in terms of value, really. So the idea is that this fund managers, that's their role. If they're actively involved, they're actively pursuing these goals. There are also what's called passive investments, meaning where you're trying to overspread the entire market. And their role is to track this, the fund manager, that is, to track this and to update this on a regular basis, your index, so that if Toyota is it is, if it pulls out of an area, or if it changes something somehow, they rebalance according to that, but for the most part, they kind of let it sit, so to speak. So diversification, this is addressing the diversification side. The investors' funds are used to purchase a variety of investments, thus reducing what? Risk. That's the objective. The advantage is diversification, so you achieve that. Professional management, somebody else is watching your money so that you presumably don't have to. We've all heard that before too, so you've got to be careful about that, but it depends upon what it is that your objectives are. Ease of buying and selling shares, and just as it is with companies, the value of those shares and mutual funds are available. You can look it up online on a daily basis, if you will, what those shares of stock, so to speak, in that mutual fund are actually worth. You can choose to a distribution of your dividend, or you can choose to reinvest it. You can reinvest if there are dividends that are offered. There's always that reinvestment option where you just continue to roll it forward. And you can, so long as you stay within that company, you can move things around however you so wish. It goes on and on. There are disadvantages. Again, there are purchase costs, withdrawal costs, etc. Management fees, depending upon the type of fund that you're in. For example, again, using Vanguard, their management fees are extremely low, less than 1% a year, meaning I think they're probably 0.5% or less than that, meaning that whatever the size of your portfolio is, their management fee is a very, very small portion. Anyway, there are downsides to this, is that you're spreading, and so you don't have as much action necessarily, meaning you don't have as much possibility to take advantage of something that you don't, because you're in the large pool, to take advantage of something that you have a good feeling that it's going to grow in value, and so on and so forth. So you're kind of restricted that way, but that's not necessarily a bad thing. It's just the nature of it. Closed-end funds, the fixed number of shares trade like shares of common stock. So a closed-end fund means that they stop issuing new shares of stock, and that's it. And then from that point on, it's going to be they're not going to be issuing any more stock in that mutual fund, ETF, exchange-rated funds. Invest in securities containing a specific securities index, so it's a narrowly defined, much more narrowly defined. Open-ended mutual funds are the majority of these. Is the shares issued and redeemed on demand, may be actively managed or match an index. Closed-end funds, specifically, we're looking at closed-end funds, fixed number of shares. So again, there's a fixed number, and you're not going to be issuing anymore, so the value is going to be going up and down, and the existing shares of stock will be traded back and forth. Okay. Again, driven by supply and demand, not necessarily based on the value of investment in the fund. It's the net asset value, NAV. That's something that changes on a daily basis, if you will. It's published on a daily basis. The net asset value, they have to come up with a settlement price, how much these funds are worth, again, on a daily basis. ETFs are exchange traded funds, invest to replicate the composition of a specific securities index. Performance mirrors that index performance, low management fees, no minimum investment. Trade on exchanges throughout the day like a stock. Price is determined by supply and demand at a given time. So these are much more like shares of stock, and the prices fluctuate, and not just on a daily basis, which is that net asset value, but on whatever the market price is during the day. Open-ended funds constitutes 82% of most all funds, basically. Shares issued and redeemed by the investment company at the request of the investors. Investors free to buy and sell shares at the net asset value, and that's market close, typically the close of business type of a situation. Net asset value, again, the value of the fund's portfolio minus liabilities divided by the number of outstanding shares. Simple. The net asset value is the the market value, if you will, of that stock at the end of the close of trade. Okay. Cost of load versus no load funds. Load funds charge commissions up to 8.5%, very, very high. And the idea, of course, is that you're paying for what? You're paying for the expertise of the fund manager, and the fees are very high, and so you have to take that into account in terms of what you're realizing your net gain. And I don't advise load funds. No load funds is what I focus on. No commissions on purchase or sale. No salespeople involved. You deal directly with the investment company, and that's it. So you're the one that's making the decisions. But this also drives back to that index. If you're not familiar with certain areas, if you're not comfortable, look at index funds that are more broad-based. The broader the base, the less risk in general, but also the more certain that you're tracking to whatever the market's doing on a particular day overall. The cost, management fees, and other charges. Management fee charged 0.25 to 1.5%. And again, the Vanguard is probably 0.1%. I'm not sure what it is, but it's the fees are very, very low. The distribution fee, annual fee to defraying advertising marketing costs cannot exceed 1% of assets per year, cannot exceed 0.25 for a fund to be called no load. So again, that 0.25 we're looking at. Expense ratio, total expenses associated with management fees and operating costs of the fund. And this walks through the load versus the non-load and the differences therein. So with load funds, you're basically paying for the expertise of the financial representative, if you will. Classify mutual funds by investment objective: long-term funds, stock funds, bond funds, other funds. Long-term stock funds, bond funds are pretty straightforward. Other funds, we'll get to that in a minute, but for the stock funds, long-term, you're focusing on aggressive growth, and this is again where you look at the index is focusing on that, and it picks up a total market index fund picks up all of these. It focuses on all of these sectors of the market, of the economy, of the pool of companies out there: large cap, small cap, large cap, mid cap, small cap, and its focus is mostly on the larger cap because that's where the money is at. Okay. Anyway, it's company size. Next, looking at bond funds. Bond funds again are based primarily on the health, if you will, of the company that's issuing the bonds. So high yield, intermediate corporate bonds, intermediate U.S. government bonds. So moving down the list to the more secure, the more less risk. So high risk on top, low risk on the very bottom, moving toward the bottom. So again, with a mutual fund, it's the same idea where you have a mix of these bonds, and depending upon the risk that you want to take on, it would be more toward, if you want more risk, you move closer to the high yield, and so on and so forth. Other funds would be, other ways of looking at this, I guess, would be asset allocation funds, balance funds, funds of funds, life cycle funds, money market funds, and this has to do with the investment strategy overall. Asset allocation funds, you divvy it up according to asset class, large cap, mid cap, small cap, and what your objectives are. Again, top to bottom, top more risk, if you will, bottom money market funds, very, very low risk, very, very low rate of return. Family of funds, one investment company manages a group of mutual funds. So again, whether we're talking about, again, we've got here Fidelity Investments, Franklin Templeton Fund, Vanguard would be also out there. They're a family of funds, and with different objectives for different groupings within that family. Managed funds versus index funds. Managed funds is when the manager is actively involved in managing those assets, buying and selling, versus an index fund. It's passive. They're just focusing on such things as like the S&P 500, Standard & Poor's 500, the 500 largest companies out there, for example. And when the index funds are lower cost because there's not much involvement, frankly. So again, there are numerous resources available on the internet, etc., that are you can get information from the various fund companies and track the performance of mutual funds and so on and so forth that are out there. Professional advisory services that are available, such as Morningstar is the one I think of. That's the one where they actually rate these rate the mutual funds based on performance and commissions and so on and so forth. Mutual fund prospectus. Once again, prospectus is a statement that describes again a walkthrough statement describing risk factors, funds, past performance, types of investments, what the focus of the company is, what their goals, what their aims are going forward, and what their past practices have, what they're planning to do, kind of going forward. Prospectus is very important. Kind of get your head wrapped around what it is that this fund is all about, this mutual fund. Annual report, again, it breaks down the performance by, performance by investment assets and liabilities, and walks through, and they're available through all these other publications, but also the mutual fund itself will provide these these documents for you. They're huge, dozens of pages. And we'll just leave it at that. Mechanics of mutual fund open account. Again, depending upon the mutual fund, depending upon your objective, and so on and so forth, you can open an account for as little as a couple $100, and some are higher in order to buy in. But to start with, you can always access mutual funds for relatively low price, and so you're buying dollar value. It's not necessarily you're buying, you don't have to go there and buy 10 shares of stock in this mutual fund. You buy $250 worth of this mutual fund. And anyhow, that's kind of the general idea. Mutual funds, income dividends. You can earn the dividend and receive that dividend based on the dividends that the mutual fund receives from the company, or you can plow it back in. Right? You can reinvest it back into those mutual fund shares, if you will. Capital gains distribution. If you sell your securities, sell your mutual fund off, gains or losses that would be associated with it. They're capital gains are taxed differently than normal income, more normal interest income, normal income. They're typically taxed at a higher rate. I think the capital gains rate is actually set at about 20% right now, but at any rate, just some slight differences. Here we go. Income dividend, ordinary taxes, ordinary income, capital gain distribution, long-term, depends upon if it's long-term or short-term. Gains or losses, if you lose, you can write that off in your taxes as well. So the purchase options, fund type, closed-end, exchange traded funds. Again, you can purchase these through exchange or over the counter markets, and with the open-ended, there no load or load, you would be buying directly from the company in this case, or you could their agent in some manner, because oftentimes you could go through, if you want to buy a Vanguard fund, for example, you can buy it directly from Vanguard, or you can go through, if you have other accounts with Schwab, for example, or Fidelity, you can typically buy other mutual funds through some other mutual fund, if you will. Purchasing open-ended fund shares, regular account transactions, the easiest, simply buy shares when desired. Voluntary savings plan allows for smaller than usual purchases on a recurring basis, so you can buy $50 worth a month, and you don't have to buy, you don't have to buy shares. You can buy dollar value, and you buy it. Of course, it's broken down. The dollar value is broken into shares. 1.47 shares of the stock, etc. Contractual savings plan require regular purchases over a specific period of time. Reinvestment plans automatically reinvest the dividends and capital gain distributions in the fund. Closed-end funds and exchange-traded funds trade on stock exchange and the over-the-counter market, sold like common shares of stock. So the prices change on a moment-by-moment basis. Open-ended fund shares sold to the fund sponsoring the company. So open-ended funds, again, this is, if you want to buy or sell them, you would be getting the NAV, or the net asset value, which is the settlement price on a daily basis at the end of the day, whatever the criteria are that are set up. Mutual fund withdrawal options, again, this is, think about it in terms, well, we'll get to that in a moment. So you can withdraw fixed dollar amounts over a period until account is exhausted, liquidate or sell off the entire value or a portion thereof. Withdraw a fixed percentage of asset growth. You can divvy it up however you'd like. Withdraw all assets, asset growth from income, dividends, and capital gains distributions. You can divvy this up however you want to. So anyhow, the takeaway from this is, open-ended funds, a fund whose share, this is what I would advise if I were to be advising. I don't do that, but this is the one piece of advice that I do offer. A fund whose shares are sold and redeemed at the investment company at the net asset value is at the request of an investor. Open-ended funds. Think, again, index funds where it's spread over a large part of the market, or in the case of the one fund, or the type of fund that I recommend are total market funds. No load total market funds. So there's very low management cost, and there's not much for the fund manager to do other than to reallocate based on the index. So move things around ever so slightly typically. And the index in this case is the entire market. So overspread the entire market, and just set it and forget it, and look at it over a period of time. And if the market goes up, if the Dow goes up, the S&P goes up, the Standard & Poor's, the S&P 500 goes up, then chances are the value of your investments have gone up. If it goes down, then the value of your investment goes down, but that's nothing. Overall, the investments have risen over time, so keep that in mind. All right. So again, another point before I wrap this up is that think about it. If you're a long-term investor, focus on equity stuff, focus on shares of stock, focus on mutual funds that are index funds spread over the market that are focused on equities, on shares of stock. You can also do the same with bonds. You can have index bond funds that are overspread the entire bond market, so to speak. So you capture everything from the high yield, the high risk, to the very, very low yield, the low rate interest rate of return, the very, very low risk. So the objective here again is to try to cover as much as the market as you can, realizing that bond funds in general, so mutual funds with bond funds generally have a lower rate of return, but there's some more safety involved. So if you're in retirement or very close to retirement, you may want to consider something like that. Again, mutual funds, whether we're talking about a stock mutual fund, or if we're looking at a bond mutual fund, and you want to have index funds overspreading as much of the market as you can. Okay.